There's an old line about how denial ain't just a river in Egypt. Well, these days it seems an awful lot of American business leaders, policymakers and pundits are lounging on the banks of denial when it comes to the reality of our economic situation. The latest data points continue to paint a picture of an economy losing steam, particularly in the all-important services sector that makes up the vast majority of U.S. economic activity and employment. Yet the common reading is a profound state of rosy revisionism. Take the August Services PMI data from the Institute for Supply Management released last week. The headline number slipped to 50.2, barely above the break-even mark of 50 that separates expansion from contraction in activity. Not to worry, the spin went, at least services are still expanding, however glacially. Pay no mind to the fact that this same index was north of 60, signaling robust growth for most of 2021 and the first half of 2022. Certainly don't dwell on the near 7-point plunge in the ISM's measure of order backlogs, the largest drop in a year. Why would ebbing demand be a concern? It's not like unfilled orders are the bloomers in the economic lingerie, providing vital support and suggesting a degree of foundational strength. It's definitely not as if shrinking backlogs, if sustained, would inevitably force companies to cut payrolls and working hours to realign staffing with diminished workloads. Oh wait, that's exactly the risk the latest ISM report highlights. The Services Employment Index slipped closer to contraction territory, with lean order books reducing the need for labor. Call it the gravity of compensation finally overcoming the artificial lifting of pandemic-era dynamics like excessive consumer savings and stimulus checks. You could simply ignore all that and repeat the soothing mantra that a services-led shift from goods towards services spending explains the slowdown. Except the August ISM Manufacturing Index also signaled the sector contracted for the 7th straight month, undermining that lazy narrative. Perhaps more annoyingly objective were the latest job openings and labor turnover survey, JOLTS, numbers from the Bureau of Labor Statistics. They revealed job vacancies in July fell to their lowest level since April 2021. A year-and-a-half valley underlining the moderating trend in labor demand. And it's not just waning wants among employers for new blood. The JOLTS report also showed the number of layoffs ticking up modestly in July, further evidence of hairline cracks emerging in a job market that up until very recently seemed impervious. The mounting signs of erosion in labor conditions come against a backdrop of inflation that has admittedly cooled from its blistering mid-2022 peak but remains stubbornly high. Just look at the ISM's Prices Paid Index rising to 57.3 in August, with half of services industries still reporting higher input costs despite copious Federal Reserve rate hikes. It's all enough to make you wonder whether the Fed's monetary policy masochism, subjecting the economy to ever more stringent liquidity conditions to squeeze out price pressures, isn't at least partially behind the slowdown now taking shape, particularly in cyclically sensitive sectors like manufacturing and housing. Of course, acknowledging any of this would require the punditry to discard their default framing of the Fed needing to hike rates even higher to fight the phantoms of 1970s-style stagflation and a perpetually overheating labor market. Sorry, that dog won't hunt, or rather, it's likely already devoured one too many high-interest rate treats. The true drivers behind persistent inflation seem to be more nuanced dynamics, many flowing from the rolling global economic ruptures of the past 2 years, massive debt-fueled stimulus, supply shocks, COVID whiplash effects, deglobalization pressures, climate impacts, and geopolitical turmoil. In that light, the Fed's increasingly ham-handed application of 1970s vintage shock therapy blunt instruments is looking more and more like bringing a hammer to perform LASIK eye surgery. Sure, you'll eventually fix high inflation, but only after blinding the patient, i.e. inducing an unnecessarily harsh economic downturn that hammers American workers and businesses. That's the messy reality the latest data hints at a more moderate cyclical slowing already taking root, with most leading indicators pointing to a Solomonic middle path between red-hot inflation and ice-cold recession. A soft landing that avoids the ditch on either side of the road is still very much in play if policymakers can muster the wisdom to tap the economic brakes more prudently from here. Yet grasping that nuanced outcome requires the clarity to see through the economic haze, a haze that has clearly addled far too many these days. Until more sharpened vision prevails, expect a lot more stumbling by all the powers that be as they careen from one denial to the next. Signs of bumpier services sector road ahead. Beyond the headline ISM Services Index, last week's report contained plenty of flashing yellow lights about stormier conditions potentially gathering on the economic horizon. Consider The backlog of unfilled orders plummeted 7 points in August, suggesting waning demand that could soon force businesses to start shedding payrolls and scaling back hours to cut excess capacity. Similar deterioration in the manufacturing backlog measure has already contributed to over 50,000 factory job losses since last fall. Respondents are indicating that demand is waning. Steve Miller, head of the ISM Services Survey Committee, conceded in the report. Meanwhile, companies judged their inventories too high by a wide margin. Another sign they overextended during the pandemic boom and will soon need to retrench. 7 of 16 services industries tracked contracted in August, with biggies like retail, construction, and accommodation and food services all in the red. Even booming sectors like tech look more wobbly, with giants like Microsoft, Google, and Amazon unleashing thousands of layoffs. The only reason the headline ISM Services Index remains narrowly in expansion territory is due to outsized gains in a handful of quirky sectors like entertainment/recreation. Fun as roller coasters and concert tours may be, they're not exactly drivers of overall economic growth. Looking ahead, the ISM panel forecasts services activity to continue sliding into next year as the cumulative impacts of Fed rate hikes finally catch up to household and business demand, what economists call the transmission lag. Falling real wages, higher borrowing costs, tighter lending standards, and deflating asset prices will all gnaw at purchasing power. The net result will likely be an overall growth stall or mild recession, a necessary cyclical reset after the artificial highs of the pandemic stimulus sugar rush give way to fiscal and monetary hangovers that could turn the services sector's slowdown from prolonged air pocket turbulence into a more harrowing drop before finally establishing a new, smoother cruise altitude. Meanwhile, the relentless negative revisions to measures of domestic demand continue, with the Atlanta Fed's GDP Now estimate for third-quarter growth recently slashed to just 0.3%. That's barely a heart murmur from the rip-roaring 6 to 7% growth rates chalked up in 2021's too much of a good thing environment. For the Fed, that economic thawing represents progress toward their goal of rebalancing supply and demand in service of taming inflation. Yet with price pressures still entrenched in both services and manufacturing, the central bank keeps warning of more rate hikes to come this year. The trouble is policymakers may not realize how tenuous the situation already is until it's too late. Recent comments show many on the rate-setting Federal Open Market Committee still view labor markets as overheated based on backward-looking data that predates the inflection we're now seeing in hiring and jobless claims. You can practically hear the out-of-touch echoes building echoes. We need to apply the monetary brakes even harder to better align labor supply and demand. By the time officials absorb the latest data, it may already be too late to avert locking the economic tires and skidding into an avoidable recession. As I've written before, this is exactly how the Fed's policymaking process, analyzing already stale data in infrequent meetings while opining on imprecise forecasting models of economy, repeatedly lands them behind the curve. With such institutional myopia, it's unfortunately an open question whether the central bank will be able to stick the proverbial soft landing. All the more reason to scrutinize the timeliest private sector indicators like the ISM surveys and not succumb to rosy revisionist delusions about the true state of the economy. The services slowdown looks real. How severe it ends up being will ultimately depend on whether America's policy pilots can shake off their current stretch of economic denial and navigate us to a smoother final approach. The scourge of revisionists' false dawns. Of course, trying to wrap one's mind around our topsy-turvy economic predicament is an inherently dizzying exercise these days. Just when you think the trajectory is finally clearing up, new gusts of data come whipping in to reshuffle the outlook. Take the seemingly positive August jobs report released last Friday by the Bureau of Labor Statistics. At first blush, the blockbuster 315,000 gain in non-farm payrolls looked like a green light for those peddling the no-recession narrative. Dig deeper, however, and the details revealed more yellow than green. The 3-month average for job growth has slowed to just 292,000, a marked deceleration from start-of-year levels above 500K, and one of the weakest paces since the tail end of the pandemic hiring frenzy in 2021. Slower, but still too fast for the Fed's liking if you buy the juggernaut labor market justification for their ongoing rate hike campaign. Always conveniently overlooked are the growing pockets of cooling already underway, not just in interest rate-sensitive sectors like housing and manufacturing but now spilling over into parts of services. The quirks and quid pro quo underlying August's payroll headline gains exemplify the data's unreliability. Over a third came from suspect sources like state and local government education hiring labeled as temporary, which has a tendency to get walked back in future revisions. Other gains were heavily skewed toward relatively lower-wage industries like leisure and hospitality or trucking and warehousing. The high-paying knowledge economy stalwarts like tech, media, and finance kept shaving heads at a rapid clip last month, more leading indicators of the spreading malaise ahead. So although the headline stats make for rousing no landing, just rebounding, punditry, the underlying internals still point to an economy rapidly losing altitude in the face of a deliberately over-restrictive Federal Reserve. Meanwhile, the revisionist powers of myopic distortion only seem to compound the longer this volatile process drags on. Why just last month, the same cheerleaders now celebrating August's blowout jobs number were busy putting a positive spin on July's surprising weakness. Back then, it was a potential Goldilocks slowdown in job growth that could help cap wage pressures and mark the elusive transition to a still hot but healthier labor market. 1 month later, the Goldilocks narrative lies shredded, exposing the fallacy of overinterpreting any single data point in isolation. This persistent risk of false dawns and misguided pivots, hailing imagined inflection points based on a solitary set of numbers, only to be contradicted weeks later, has bedeviled economic discourse throughout the post-COVID cycle. And it keeps leading to dramatic overreactions in both words and policymaking. Reality is, the economy rhymes rather than repeating prior cycles in perfect cadence. So handicappers anchored to mental models of past business cycles and inflation dynamics are bound to be constantly confounded by the unprecedented dynamics unfolding these days. Rapid labor churn, start-stop supply and demand shocks, structurally stickier costs, ballooning debts, deglobalization crosscurrents. None of these modern curveballs fit neatly into models harkening back to the 1970s or even the cautiously coddled 2010s recovery. Superimposing traditional rubrics onto an idiosyncratic cycle is a recipe for perpetual headfakes and whiplash. The truth is, most recoveries from prior downturns transpired under far less exotic backdrops than today's entangled mess. Central banks gradually nursed economies back to health through ever-easier monetary policy, given little reason to abruptly jam on the brakes. Growth would smoothly accelerate as labor markets tightened and demand returned. In our present trauma-born era, it's the downshift that's unfolding gradually and haphazardly. Like a semi-truck struggling to slow on a winding mountain grade, the economic deceleration keeps overshooting as the Fed strikes an overcorrected path between braking and gravity's pull. In the process, high-profile imbalances and dislocations are manifesting by the month. Sudden bouts of supply-demand whiplash, intermittent hiring and firing frenzies, pinballing inflation prints. Momentum doesn't just evaporate in a smooth linear drift this time, but in chaotic spurts and halts pervaded by noise and mixed signals. That's what makes placing too much weight on any single month's numbers, or succumbing to false economic dawn reportage, so perilous these days. With so many crosscurrents swirling, the data's inevitable month-to-month chop gets magnified into sweeping narrative shifts that inevitably get upended in short order. To see through the haze requires patience, perspective, and a wider aperture of indicators spanning multiple timelines over which to synthesize reality's intricate patterns. In short, nuanced analysis, not the sort of black-and-white absolutism that tends to polarize discourse and policymaking alike. Services sector signposts of the bumpy road ahead. If you've stayed with me this far, the latest ISM Services report provides exactly the type of nuanced, leading evidence crying out for clearer interpretation against the noise. Behind the headline's top line of 50.2 lie a number of unmistakable yellow flags about turbulence still to come. The new orders gauge improved negligibly to 51.5 in August, essentially remaining stuck in neutral after crossing into contraction territory over the summer. With backlogs plunging nearly 7 points to 48.8, signaling an outright decline in unfinished work, any stubborn new order weakness in coming months will quickly force companies to cut labor and operating capacity. Unsurprisingly, the ISM's employment measure slipped closer to contraction at 50.2, one of the more forward signposts of payroll strains ahead. As Miller, the survey chair, noted, slow to moderate growth was cited across many industries, while high costs and interest rate pressures were often mentioned as negatively impacting business. In other words, the cumulative effects of Fed tightening are only now starting to crimp services activity at the margins, with the full impacts still unfolding due to those maddening monetary policy transmission lags. More acute demand destruction is likely around the corner once the financial plumbing gets further kinked by higher rates. Meanwhile, Inventory sentiment among services firms swung back to an excessive reading of 56 in August after 1 month of fleeting contraction. This restocking likely reflects decisions made back when the goods demand boom was still raging. But with spending patterns dramatically rebalancing, those same stockpiles now loom as future drags on forward production, sales, and hiring. It's essentially the same story playing out in manufacturing, where order books, production, and employment have all steadily downshifted into contractionary terrain this year. The only difference is activity levels in factories tend to lead services, so the latter's descent is simply reaching the trail mix a few months after industry. Once notorious pockets like housing, tech and finance get fully factored in, the shedding of excess services capacity built up over the past 2 years is liable to gather even more force. And as ever larger chunks of the economy tip into contraction mode, the spillovers risk morphing what is currently a cool-down phase into an outright cyclical downturn. Of course, none of these leading harbingers portend a services collapse akin to 2008 or 2020's cliff diving. We're unlikely to see mass layoffs spike the unemployment rate from cycle lows anytime soon. But the writing is on the proverbial subway wall. The post-COVID services boom is giving way to harder times and slimmer payrolls in labor's biggest arena. For now, the sector's sprawl may simply be settling into a shallower, flatter cruising altitude after the past 2 years' gangbusters ride. But the Fed's current trajectory of aggressive rate hiking, combined with fading pandemic relief fiscal juice, threatens to push services into an unplanned stall or worse before stabilizing, making the Fed's policy turbulence even worse. The irony is this very real descent into service sector sluggishness exposes the Federal Reserve to an even more acute bout of air turbulence in the coming months and quarters. By being late and haphazard in addressing early inflation flare-ups, the central bank is now inevitably reacting to both old and new data in exaggerated, overcorrecting fashion. Like a pilot awaking groggy from complacent autopilot only to find their plane wildly off course, the Fed overcompensates with draconian overcorrections. The resulting whipsaw in policy has the plane lurching drunkenly first one way, then another, struggling to steady itself while leaving everyone queasy and desperate for the ride to mercifully end. So it goes when policymakers ignore drift for too long and then succumb to panic mode. Lacking discipline or credibility, they inevitably lash from one extreme to the other, serially reacting to lagging data prints in dramatic pendulum swings. This is more or less how the Fed spent all of last year stuck in inflationary transitory purgatory, blithely waving off mounting price pressures as fleeting before whiplashing into Carteresque inflation panic in 2022. Their extreme policy U-turn, abruptly jackrabbiting from zero interest rates to the most aggressive tightening campaign since Paul Volcker, is what's now causing so much disruptive economic air pockets. Having fallen drastically behind the curve, the Fed is now overcompensating for its earlier blasé inaction. Rates are getting ramped up at a maniacal pace based on backward data confirming realities that may no longer fully apply. By the time the central bank's notoriously lagging lens catches up with current conditions, it will have already massively overshot in reining in demand. You can see this process playing out in real time with the rapidly softening services landscape. The Fed's target of squeezing services inflation is already being achieved via deceleration. Yet officials remain singularly focused on payrolls data from several months ago supposedly showing an overheated jobs market still requiring a severe cooling. So at each policy meeting, the rate-setting committee dutifully appraises old employment costs already being relaxed by organic economic forces. And each time, like ill-fated pilots chasing the rearview mirror, they pile on even more heavy-handed, throwback tightening meant for circumstance that have already shifted underfoot. The risks of this folly are clear. By reacting to increasingly backward indicators, the Fed keeps applying the monetary policy brakes ahead of when and where they're truly needed. It all but guarantees an excessive, discontinuous tightening cycle that slams the economy into an unnecessarily harsh downturn. Already, leading indicators are flashing code red levels last seen in previous recessions. The Fed might finally relent once a negative GDP print confirms lagging reality, at which point it will almost certainly have grotesquely overcorrected policy yet again, plunging the nation into an eminently avoidable slump. Sadly, this cyclical pattern of persistent Fed overshoots is nothing new. The last 2 recessions were both exacerbated by central bankers sleepwalking through pivotal junctures before compounding initial policy blunders with more egregious overcorrections on the back end. Whether it was Greenspan's disastrous 2000 tightening cycle that baked in the tech bust and mild 2001 recession, or the Fed's stop-and-go policy whipsawing that catalyzed the 2008 housing implosion. Boom and bust volatility is an inherent byproduct of reactive policymaking. Ever inebriated by hindsight, officials inevitably oversteer from one imbalance to the next, sowing the seeds of the cycle's next downfall. This same insidious process is now playing out with respect to the service sector slowdown. As leading evidence piles up of economic traction waning in services, the Fed myopically retains its laser focus on phantom labor market bogeymen that have already melted away like mirages in rear view. All because officials refuse to directly address the latest inputs, instead clinging to outdated models and intellectual anchors from bygone eras. Their reaction function forever chases the past while present realities keep shifting beneath their feet faster than the lagging government data can capture. To earnest centrists assessing the Fed's predicament, it almost feels as if the central bank is willfully ignoring the very real-time clues contained in private sector surveys like the ISM reports. As if validating reports reflecting actual business conditions might force an acceleration of their own outdated narrative and bring needed humility to a group that remains defiantly late behind the cycle's curve. So instead of learning from the ISM's forward insights, Fed officials succumb to rigid groupthink, regurgitating increasingly stale talking points each meeting to justify doubling down on policy overcorrections that risk overshooting more rungs on the tightening ladder than necessary. And lest we forget, all this denial and institutional stubbornness is being overseen by the same Fed leadership that for years blissfully dismissed inflation pressures as transitory right up until the very moment they went stratospheric. That same crew whose very credibility gap is now forcing even more severe policy extreme make amends for squandered opportunities. With each passing data cycle, it becomes clearer the Fed either utterly lacks the institutional agility, or perhaps even the intellectual curiosity, required to deftly navigate the complexity of our current moment. They remain beholden to models and analytical rubrics unequipped to cope with the epical supply-demand maelstrom unleashed by COVID's disruptive wake. What we're left with is a rigid, backward-looking central bank devoid of nuanced policymaking, exactly the wrong medicine for the volatile, multidimensional economic forces afoot. Like a doctor excessively treating narrowly defined symptoms and neglecting holistic diagnostics, the Fed's tunnel vision and excessive interventionism only breed new problematic side effects. That should worry anyone hoping for a soft economic landing from the chaotic crosswinds engulfing American services and beyond. Because without a willingness to incorporate all available real-time signals into a more comprehensively informed policymaking lens, the central bank runs a high risk of crashing the entire aircraft.